Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance. Today we're diving into AParadise Acquisition Corp's latest 10Q. And let's just say this company's story is quite the roller coaster of pre-IPO jitters and financial maneuvering. So what's the big picture here? This report covers the period up to June 30th, 2025. Giving us a look at AParadise Acquisition Corp, a company that's essentially a shell company, also known as a SPAC, looking to merge with another business. We'll break down their financial health, their big plans, and let's start with the balance sheet, a snapshot of what the company owns and owes. As of June 30th, 2025, we see total assets around $96,000. Now that might sound small, but remember this company is still in its early stages, preparing for its main business event. What's more telling is their liabilities, which are a bit higher, around $390,000. This means they owe more than they currently have on hand before their big IPO deal even happens. They have a significant amount due to a related party, which is basically money owed to someone connected to the company, and a promissory note also from a related party. When we look at the income statement, it's pretty straightforward for a company that hasn't really started operations yet. For the 3 months ending June 30th, 2025, they reported a net loss of about $18,000. For the 6-month period, that loss grew to about $52,000. This isn't surprising, as these are essentially the costs of setting up the company, legal fees, and getting ready for their public offering. Looking at the shareholders' deficit, it reflects the company's early stage. They have shareholders' deficit numbers that are negative, which is typical for startups and SPACs before they complete their initial business combination. It's essentially showing that their early expenses have outpaced any initial investment beyond the seed money. Now let's talk about cash. The statement of cash flows tells us how money is moving in and out. From their operations, they used about $49,000 in cash for the 6 months ending June 30th, 2025. This is mainly due to those operating expenses we just saw. On the financing side, they received about $120,000 from a related party for a promissory note. This shows they are borrowing money, likely from their sponsor or affiliated entities, to cover their setup costs before their big IPO. So who is AParadise Acquisition Corp? They are a blank check company, which means they are formed with the sole purpose of raising money through an initial public offering or IPO to acquire an existing company. Their intention is to target businesses in the leisure and entertainment sector. They were formed back in November 2022. Now, here's where things get interesting. The report mentions their IPO. Their registration statement became effective in late July 2025, and then they sold 20 million units at $10 each. That's a massive 200 million units at $10 each. That's a massive 200 million units at $10 each. That's a massive $200 million raised. Each unit typically includes a share and a right to buy more shares later. They also had a private placement selling more units to their sponsor and an underwriter bringing in another $6 million. But hold on, raising all that money comes with costs. They spent over $6 million on transaction costs, including underwriting fees. This is pretty standard for SPACs, but it highlights the significant expenses involved in going public. They're also an emerging growth company, which gives them some flexibility with reporting rules. This means they can choose to follow newer accounting standards a bit later than other companies, which can sometimes make comparisons tricky. We see that deferred offering costs were significant, over $95,000 by June 2025. These are costs directly linked to the IPO that haven't been fully expensed yet and will be accounted for when the IPO is finalized. This part is crucial for SPACs. The company accounts for its Class A ordinary shares that can be redeemed by shareholders because these shares might be bought back by the company. They are considered conditionally redeemable and are treated as temporary equity, meaning they're not part of the company's permanent ownership structure. Essentially, if the SPAC doesn't find a business to acquire, shareholders can get their money back. Let's talk about who's involved. The company sponsor, a company called ASPAC IV Holdings Corp, plays a big role. They acquired founder shares for a nominal amount, just $25,000 for millions of shares. They also provided loans to the company. For example, a promissory note of up to $300,000 was issued by the sponsor to the company. This is common as sponsors fund early operations. The report details how the sponsor's ownership of founder shares has changed, with some being reacquired. It highlights the significant stake and early investment made by the sponsor, which is typical in the SPAC world. Here's what happened after June 30th, 2025. The biggest event was the IPO itself, which closed on July 31st, 2025. That's when they actually sold those 20 million units and raised the 200 million units and raised the 200 million units. This report is covering the period before that major event, but the subsequent events section clearly states that the IPO did occur. Moving into the management discussion and analysis section, the company reiterates that they are a blank check company aiming for a business combination. They expect to incur significant costs and can't guarantee success. They are pretty upfront about the risks involved. In terms of liquidity, before the IPO, their cash situation was tight. They relied on funds from the sponsor, including a $300,000 promissory note. After the IPO, a huge chunk of that money, $200 million, was placed in a trust account, meant to be used solely for the business combination. The money outside the trust account is for operational expenses. This is a key operational point. They are not generating revenue because they haven't acquired a business yet. Their focus is entirely on finding and merging with a target company. Management explicitly states that the conditions existing raise substantial doubt about the company's ability to continue as a going concern. This is a significant statement, meaning there's a real possibility they might not make it if they can't find or complete a business combination within their time frame. Their plan to address this is through those working capital loans. On the controls front, management believes their disclosure controls and procedures are effective. These are the systems in place to ensure that all important information is accurately reported on time. They acknowledge the inherent limitations of any control system, meaning there's always a small chance of errors or fraud slipping through. But overall, they seem confident in their processes. This section lists all the supporting documents filed with the report. You'll see things like the underwriting agreement, various subscription agreements, and legal documents that lay out how this whole IPO process is structured. It's like the detailed blueprint of their financial and legal setup. Now let's put on our thinking caps and look at the bigger picture here for AParadise Acquisition Corp. This company is by its nature a high-risk, high-reward vehicle. They've successfully raised a substantial amount of capital through their IPO, which is a major hurdle cleared for any SPAC. Their intention to target the leisure and entertainment sector could be lucrative if they pick the right company. The early stage losses and the related party loans and sponsor funding are all standard for this business model, showing they're playing by the typical SPAC playbook. However, the substantial doubt about the company's ability to continue as a going concern is a big red flag. It means that without a successful business combination, the company might not be able to stay in business. This is why SPACs have a limited time frame to find a target. Any delays or failed negotiations could lead to liquidation, leaving shareholders with very little. The significant transaction costs also eat into the capital raised, a common downside of SPACs. While they've raised $200 million, a good chunk of that is used up in the process of going public. My take is that this company is in a very precarious, but potentially very rewarding position. Their success hinges entirely on management's ability to identify a strong target company and execute a favorable business combination before their deadline. The going concern warning is a serious one, reminding everyone that SPACs are speculative investments. The key risks here are failure to find a suitable target and the inherent volatility of the markets they aim to enter. What's your take on AParadise Acquisition Corp's strategy and these early stage financials? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more in-depth looks at corporate filings. And don't forget to join our Discord community for more discussions and insights linked in the description. Thanks for watching, and I'll see you in the next video.